Welcome to this class on the financial coverage, part 3, that is focused on the cost of capital. So it's last class about financial coverage. This is the outline of the class, so we'll first have a brief introduction about the topics of the class of today. Then we'll recall the financing structure of a project, and we'll link that to the cost of the different sources of finance. Then we'll analyze in particular the cost of equity. Then we'll look at the cost of debt. And finally, we'll determine the weighted average cost of capital, that is also defined as WACC, that is the total capital, total cost of capital that the firm has to pay in order to raise the financial sources needed for the realization of the project. So here we start from the introduction. And the introduction says that the cost of capital of a project depends on two specific issues. One is the financing structure. This means in particular how much debt and how much equity the project sponsor decide to use to cover the financing needs of the project. And then clearly the cost of capital will depend on the specific costs of debt and equity. So in the end, these two variables will determine the cost of capital for a project. Clearly the objective of the firm, as we'll discuss also in greater detail at the end of this class, is to have the lowest cost of capital, because for the firm, raising financial sources is a cost, and the objective is to choose the financial sources and to determine a financial structure that allows the firm to minimize the cost of capital for this project. So now we'll analyze the different determinants of the cost of capital of a project, and then we'll see how we can use the financing structure in order to reduce this cost of capital. So as I was saying before, in order to analyze the calculation of the cost of capital, we have to start again from the financing structure of a project. And if you remember, in previous classes, we have defined this scheme for the analysis of the financing structure of a project. And this is substantially a balance sheet, where on the left side you have the invested capital, whereas on the right side you have the different sources of financing that you can use for the invested capital. In particular, at the very first level, you have equity and debt, as already discussed in the previous classes. So now what happens is we have already dealt with this problem. Equity and debt bears a different level of risk, and so therefore have different expected returns. So the fact that equity investors and debt investors have different expected returns also mean that they have different cost of capital for the firm. And in this slide, you can see that we define as K with E as the cost of equity and KD as the cost of debt. So as we can clearly see from this slide, the cost of capital that the firm has to sustain in order to raise the needed capital for the project will depend on KE, so that's the cost of equity, KD, that is the cost paid for debt financing, and clearly the proportion of equity and debt, because here the proportion of equity and debt will affect the relative weights of KE and KD on the total cost of capital, as we'll discuss in a more formal way in this lesson. So let's look at first of all at the cost of equity, and let's look at what the determinants of cost of equity are. So first of all, we have to remember that the cost of equity is the return required by equity holders. So the equity investment involves the commitment of funds which have an opportunity cost for shareholders. So the fact that shareholders invest in these specific projects means that they are foregoing other potential alternative investment opportunities. So here there is an opportunity cost in terms of loss return on other alternative investment opportunities. So in order to calculate the cost of equity, and in particular the rate of return that the equity holders are expecting from this project, we have to understand what the benefits for them will be if they had invested in the best alternative opportunity. And we also to remember that the typical assumptions that is made in finance is that investors are risk averse. So this means that investors do not like risky investments. So what does it mean? This means that if an equity investor can choose, if he can choose between two different investments having the same returns but different degrees of risk, he will decide to go for the investment having the lower degree of risk, because given the level of return will guarantee a lower level of risk. And therefore, the cost of equity depends on risk. So in other words, what the logical process here is the following. When an equity holder is investing money in a project, is foregoing other alternative investments. And in particular, is foregoing potentially equally risky investments. So what we have to calculate here is the return that this equity holder will get from an alternative investment opportunity having the same level of risk and with a given rate of return. Because in theory, the rate of return that the equity holder is expecting from our project, that is also the cost of equity for the firm, should be equal to the rate of return that is guaranteed by the alternative investment project having the same risk. So this is the typical logic process that is involved in the calculation of the cost of equity, and therefore in the calculation of the return that is expected by a shareholder. We can try to formalize this kind of reasoning into a formula that allows you to determine in a more analytic way the cost of equity. Because the alternative we were describing before, that is looking at an investment opportunity having the same risk and calculating the expected rate of return and applying then this rate of return to our project, is not often feasible. In practice, it's never feasible, because it's very hard to find a project that has exactly the same risk for which I know ex ante the rate of return. So I need to apply some analytic model if I want to predict the cost of equity. And the cost of equity in the formal model that have been developed in the theory depend on two parameters. One parameter is the expected return on a risk-free asset that we define as RF, and the risk premium. So let's look in greater detail to these two parameters. Okay? So the expected rate of return of a risk-free assets is the rate of return that an investor can expect by investing in an asset that is risk-free. And we have to say that from a theoretical point of view, there is always in the perfect world a risk-free asset. We have to say that in the real world, it's much harder to find risk-free assets. But in general, you can consider the government bonds of developed countries as a good proxy of risk-free assets, even though they will never be completely free of risk. But the government bonds issued, for example, by United States or Germany can be reasonably considered as assets that are risk-free, so that they do not involve the risk that the principal is not repaid. So the rate of return on a risk-free asset could be assessed by looking at these kinds of assets that are government bonds issued by developed countries. So now the issue is that the risk-free asset is clearly underestimating the rate of return required by an equity investor. And this is for a very simple reason. So if an equity investor was asking a rate of return on its equity investment equal to the rate of return of a risk-free asset, his decision will be clearly suboptimal if we remember the assumption that the investors are risk-averse. Because by investing in a project having the same rate of return of a risk-free asset is bearing a lot of risk that is typical of industrial projects, infrastructure projects, and in general these kinds of projects. Whereas he could invest the same money in a risk-free asset, getting the same return, and without carrying any risk. So it's the rate of return that shareholders expect from a given project is to be clearly higher than the rate of return that I would expect from the investment in a risk-free assets. Therefore, in estimating the rate of return that the shareholders expect from their investment into a project, we have to calculate some kind of risk premium, where for risk premium we mean the higher rate of return that is required by an investor to invest in a project instead than in the risk-free assets. So the problem now is how to formally determine this risk premium. So the question is, how much is the interest rate that a shareholder would ask to be compensated for the higher risk he's assuming by investing in the project rather than in the risk-free assets? And in order to answer this question, we have to define two parameters. Because, first of all, we need a measure of risk. So clearly, we cannot calculate a risk premium if we have not a measure of risk that can be quantified and using in this formula. The second parameter we need is the price of risk, in the sense that if we calculate that a given project is a given level of risk, we want also to know how much the investor want to be compensated for assuming that higher risk. So in other words, we have not only to measure the risk, but we also to measure the price that the investor is imposing on the firm for assuming that specific risk. There are several different models that have been developed in the literature of finance and that have been implemented in professional practice. But the most used one and the most known model in the professional world is defined as Capital Asset Pricing Model, or CAPM. So according to this model, that is quite complex proof, but is very simple result, the risk premium that we were discussing before depends on two components. These two components are defined as equity risk premium, or ERP, and beta. In particular, in this formulation, the equity risk premium represents the price that an investor is asking for taking higher risk, whereas the beta is measuring the risk itself. So it's saying how much risk a given project or a firm is bearing. Okay? And then we'll describe these two parameters in detail in a moment. But the very simple conclusion of the capital asset pricing model is that the risk premium is just the product of these two parameters. So as we can see here in this slide, we have substituted the expression risk premium with the product of beta and ERP, or that is the equity risk premium. In this case, applying the capital asset pricing model, we can easily calculate, or easily depending on clearly the availability of data, but if data are available, we can easily calculate the KE, that is the return expected by shareholders from this project, is RF, that is, we remember, is the rate of return expected on the risk-free asset, and the product of beta and ERRP that we'll describe in a moment. So once that these three parameters, RF, beta, and ERP, have been estimated, and then we'll have a brief discussion about that, we can easily calculate the rate of return that in equilibrium an equity holder is expecting from his investment in our project. So let's talk a bit about what the equity risk premium is. So the equity risk premium is defined from a formal point of view is the difference between the expected rate of return from the stock market and risk-free asset rate of return. So in other words, this is a premium that the investor is asking for investing in a portfolio of stocks that are typically traded in a stock market rather than the risk-free assets. So if, for example, the equity risk premium is 5% and the risk-free asset is an expected return of 2%, this means that in order to be convinced to pass from an investment in the risk-free asset to an investment in the portfolio of stocks, the investor requires a premium of 5% over the return of the risk-free assets. So this means that the total return that I expect from investing in a portfolio of stocks traded in a stock market is 7%, where the 7% is given by the 2% return of the risk-free asset and the 5% of equity risk premium. So in other words, the equity risk premium is a higher rate of return that is required by the investor in a given system to switch from an investment in the risk-free asset to an investment in a portfolio of stocks that are traded in that country. So as you can expect, these parameters are not so easy to be calculated because it's typically recognized by the investors in different ways, so it drives their investment choices, but sometimes in an implicit and unobservable way. So one typical way to analyze the risk premium, the equity risk premium, is looking at historical data. So what you typically do is to analyze the historical returns of the stock market, comparing them to the historical return of the risk-free asset over a long period of time, for example, 50, 60 years, and then just calculate the equity risk premium as the difference between the average return on the stock market and the average return of the risk-free asset. There is, in this case, a professor that is Kenneth French that has a very detailed website where he's reporting the data on equity risk premium for different countries. But please consider that in general, the equity risk premium that is used for developed countries in the professional practice is typically comprised between 4 and 6%. So this is what typically comes out from the historical analysis of equity risk premium. Then we have to look at the beta. So the beta is defined as the sensitivity of stock or project returns to stock market returns. So if we were just considering the equity risk premium in determining our risk premium, that will not have allowed us to consider the characteristic of the project, because the equity risk premium is the risk premium required for all the stocks that are traded in that market. But as we know, different stocks could bring different degrees of risk. So we have to introduce one measure that allows us to distinguish the risk that is typical of that stock and not of the stock market portfolio as a whole. So this measure that is used in capital asset pricing model is defined as the beta. So the beta is simply stated as the sensitivity of the returns that a stock or a project is in comparison to the returns of the stock market of the country where the project is executed. So what does that mean? Let's try to interpret the beta with a very simple example. So let's assume that the stock market index of a given country in one day rises 1%. So this is the return of the stock market. Let's assume that our stock is a beta equal to 2. So what do we expect? We expect that the return of that stock will be twice the return of the stock market, so it will be 2%. But at the same time, if the stock market index decreases 1%, we expect that the return of the stock with beta equal to 2 will be minus 2%. So this means that the stocks that are beta higher than 1 have returns that are more volatile, that is more risky, than the market as a whole. So these stocks requires a higher rate of return, as it's clearly understandable from the formula of the capital asset pricing model. On the contrary, stocks that have a beta lower than 1 are more secure, are less risky. And in fact, when a stock has a beta equal to 0.5, and stock market index decreases of minus 1%, the return on the stock will be only minus 0.5%. In other words, stocks with beta lower than 1 will have lower volatility than the stock market as a whole, so they are less risky. And therefore, given the risk aversion assumption, and therefore also given the capital asset pricing model, their expected rate of return will be lower. So in these cases, when you have an investment in a business with a beta lower than 1, typically you expect a lower cost of equity for the funds that you raise as equity capital. And finally, if a stock is a beta equal to 1, the risk of this stock will be exactly equal to the risk of the stock market portfolio. So in this specific case, the rate of return that I expect from the stock of the project will be absolutely equal to the rate of return I expect for the stock market portfolio. And this can be clearly inferred from the capital asset pricing model equation. Because if you take beta equal to 1, the risk premium will just be equal to the equity risk premium. So now where do I get the beta if I need to estimate the cost of equity? Well, the beta is typically calculated on the historical returns of the stocks as compared to the historical return on the stock market. So in other words, from a statistical point of view, in order to calculate the beta, you regress the historical returns of the stock on the historical returns on the market. If you have not if you don't want to run the regression, however, you can easily get the information on the beta of traded stocks. If you have access to databases like Reuters or Bloomberg, this is a data that is easily provided. But this is a data that is also provided by free data providers like Yahoo Finance. So you don't need to run the regression. You can easily get this information from existing data providers. If the project of the firm is not traded, it's more complicated to get the beta, because as the beta is calculated on historical returns, if the stock is not traded, then you have not the raw data that you need in order to calculate the beta. So in this case, the procedure for beta calculation is a bit more complicated. And what you have to do is to find the company or a product that is comparable to your project, but that is traded on a stock market. So it's stocks that are traded on the stock market. And at that point, you can use, with some adjustments, the beta of the comparable traded stocks in order to calculate the beta of your company or project. So we have now concluded the cost of equity, and the conclusion is that once that we have the three information we need, we can easily calculate that using the capital asset pricing model. In the case of cost of debt, calculating the cost of debt is much easier, because differently from the equity cost of capital, this is contractually negotiated. So the equity, we have to calculate the cost of equity in a formal way because there is no contract between the firm and the equity holder about the rate of return, as we were discussing in the previous class. In the case of the cost of debt, it's much easier to get this information because the cost of debt is negotiated and is formally representing the contract between the firm and investors. So in this case, we're not particular problem in getting KD. We have just to look at the contracts with the banks of other investors. If there are other fees different from interest payments in the contract, these fees are clearly part of the cost of debt as they sum up to the interest payment and they are a cost for raising this capital. But there is one issue that we have to consider when we analyze the cost of debt, that is the interest tax shield. What does it mean? The interest tax shield means that when a firm is paying interest and other costs to a bank or another investor for raising that capital, it's saving taxes because interest and other financial costs related to debt are tax deductible costs. So this means that they reduce the pre-tax income and so they reduce the taxation that firm is going to pay in any given period. So in the end, the real cost of capital after including the effect of taxation is lower than the nominal cost of capital that instead is fixed by the loan contracts. Let's try to understand better how the interest tax shield works looking at a very simple example. So here we have an example of how the interest tax shield works. So we know that interest payment is a tax deductible cost. So let's consider a case where we have an initial loan of 10,000. We have an interest rate of 10%. So here for simplicity we are ignoring other costs for the debt. We have a tax rate on corporate income of 40%. And therefore the interest payment we expect for the next period is the 10% of the loan balance, that is 10,000, so it's 1,000. However, when we pay 1,000 in interest, we'll have a tax saving because this 1,000 of interest payment is tax deductible, so this 1,000 will reduce our pre-tax income, and therefore this 1,000 will pay 40% of taxes less than what we would have paid without the interest. So the tax shield generated by the interest payment is equal to the tax rate, that is 40%, multiplied the interest payment, that is 1,000. So the tax shield is 400. What does that imply for the cost of capital, and in particular for the cost of debt? Well, that the interest payment net of taxes, so once that we consider the interest payment with the effect of taxation, the net interest payment that the firm makes is 600 because from the 1,000 that is the payment that the firm makes to the bank, you have to subtract the 400 that comes back to the firm as a tax saving. So the net interest or the after-tax cost of debt can be calculated as the interest rate KD times 1 minus the tax rate. So in our example, the KD was 10%, the tax rate was 40%. So if we multiply the 10% interest rate times 1 minus 40% of tax rate, we get an after-tax cost of debt of 6%. So this is the real cost of debt for the firm, and this is the parameter that we have to consider when we calculate our cost of capital. And here, before going to the calculation of the weighted average cost of capital, I would like to stress one important point. So the taxation has an impact on the cost of debt because interest payment is tax deductible. On the contrary, taxation has not an effect on the cost of equity, and as we saw before in the capital asset pricing model, taxation was not included in the calculation for a very simple reason. Is that because when you pay dividends to the equity holders as a form of remuneration, dividends are not costs, but are cash payments, and being not costs are not tax deductible. So when you raise equity, you have not a tax saving. So this is a very important issue that we have to consider, because debt, in theory, is more convenient than equity when you fund the firm, because it implies a tax saving that equity is not able to guarantee to a firm. So let's see now, to conclude our class, how these considerations are summarized into a unique and synthetic indicator of the cost of capital of the firm or the project. This synthetic indicator of the cost of capital of the firm is defined in finance as weighted average cost of capital, or WACC. So the weighted average cost of capital is the same definition. The definition itself is saying it's just a weighted average of the cost of debt and the cost of equity, where the weights are respectively the weight of debt and the weight of equity on the total financial structure of the project or of the firm. So the formula is represented here in these slides. So as we already know, KD is the cost of debt before taxes. TC is tax rate that firms are paying on corporate income. So we have defined before the product between KD and 1 minus TC is the after-tax cost of debt. So this product is the after-tax cost of debt. This after-tax cost of debt has to be multiplied by the cost of debt over the financial structure. So this ratio, that is debt over debt plus equity, is the weight of the debt over the financial structure. In other words, if you have financing need for this project of $1 million, and you take 400,000 of debt and 600,000 of equity, the weight of debt on the total financial structure, or on the total financing need, will be 40%. So KE is the cost of equity, it's calculated by the capital asset pricing model, and E over D plus C is the weight of equity over the total financial structure. So in the previous example, we say that with 600 of equity, 1 million of total financing need covered by these financial sources. So in this case, the cost of equity is the weight of equity is 60%. So you have to multiply the after-tax cost of debt times the weight of debt, and you have to multiply the cost of equity times the 60% of the weight of equity. So this is the formulation of the weighted average cost of capital. But in order to conclude, let's understand better the meaning of the weighted average cost of capital. So the weighted average cost of capital, as I was saying before, is a synthetic indicator of the total cost of capital that the firm is going to pay in order to raise all the financial sources that are needed for the investment project. So in other words, it's a synthetic indication of the cost that the firm is going to pay for raising capital. So if from the previous formulation, it comes out that the WACC is equal to the 8%, this means that each year the firm will pay an 8% of the existing capital for raising the sources that are needed for financing of the project. Why this is important? Well, this is important for a very simple reason. That if the cost of capital is 8%, you expect that the rate of return of the project is to be higher than 8%. So when you arrive to the final phase of appraisal of a project, you want that the return of a project is higher than the cost of capital, because it will be counterintuitive to fund the project that has a rate of return lower than the cost of capital. So for example, if the rate of return of the project is 5% and the cost of capital is 8%, for each dollar of capital that you raise, you pay the 8% and you get the 5%. So that will make nonsense for the investor, and the project should not be realized. So the cost of capital is a benchmark to understand whether a project should be realized, and you compare the WACC with the rate of return of the project to understand whether the project is feasible, and this is something that we'll stress in the next classes when we'll talk about the quantitative methods for project valuation. and finally, we have also to stress that WACC is a parameter that is needed to drive the choices about the financial structure design. So what does it mean? It means that, as we have discussed in this class and in the previous class, in order to fund a project, you can discretionary choose between debt and equity. Okay, so we've seen that debt and equity have different characteristics, have different risks, have different costs. So the different balance of debt and equity will have an impact on the cost of capital. And as we said several times, you want to build a financial structure that minimizes the cost of capital. So apparently, we could say that as the debt is less risky, so less costly than equity, and as the debt is also allowing the firm to exploit the tax shield, debt is more convenient. However, this is a simplistic conclusion because, the simplistic conclusion will be that in order to minimize the cost of capital, you should have 100% of financial structure or funded by debt. And this is clearly a nonsense. And this is a nonsense because debt is less risky than equity until a certain point. But when the project has too much debt, or the firm has too much debt, so there is too much leverage, how you say that in financial terms, the debt becomes too risky, and so the increasing cost of debt creates a negative effect that is more than proportional than the beneficial effect of using debt as a source of financing. So there is a given threshold of debt over financial structures, of debt that you can use, after which the cost of capital stops increasing again with debt. So in other words, the cost of capital initially increases with debt, but after some point, the debt will have a detrimental effect on the cost of capital, and it will be beneficial to reduce debt instead of increasing it if the firm wants to minimize the cost of capital. So at this point, we have finished the classes on the financial structure and financial coverage. We have seen how the firms can tap into different sources of financing to satisfy the financing need of a project, how these sources of financing are different in nature, risks, and cost, and how this has a final implication for the cost of capital that is a critical parameter, as we'll discuss in greater detail in next classes, for project appraisal and valuation. So at this point, the lesson is finished, and I remember that you can upload other materials from the course website, and I thank you for the attention.